asked a fundamental question and the right one. I think it's a case right now when we look at what are the catalysts for this volatility that we're experiencing. They're so exogenous, meaning they're from geopolitical risk, they're from policy risk, political risk. They're so hard to forecast, right? We joked that it's hard enough to forecast capital markets. It's nigh to impossible to forecast politicians. That said, the fundamental question that we're hearing is this the start of a bear market or is this a correction? I would argue there is a path we certainly could get to a bear market, but this more likely than not is just a uniquely messy correction. And again, it's because it's so hard for investors to try to determine what are the catalysts that are going to move us forward or take away some of that uncertainty that's causing this intraday volatility. As you iterated, it's certainly trade restrictions and tariffs in the past that's going to take. It's UK politics with respect to Brexit. It's certainly even the CFO from Hawaii that's now in the extradition potential and criminal accusations in Canada. There's plenty of sources. You can throw in Italy as well, although that's one that maybe goes on the positive side of the ledger, as it looks like they're negotiating a budget that's a little bit closer to the EU's expectations in terms of percentage of GDP.
Hey, Doug, this is Christine. I mean, lots of concerns about the inversion of the U.S. yield curve and what it means for the U.S. economy. What are your thoughts about a slowdown next year for the U.S.?
No, it's a really good question. Is this, is what we're seeing on the short end of the yield curve really prescient or foreboding with respect to the path? Well, there's no doubt that it looks like there's a likelihood that we will slow relative to the expectations and relative to the growth that we've experienced in 2018. When I look at what's going on in the U.S., particularly with respect to fixed income markets and the yield curve, what really stands out to me is there seems to be a disconnect between what fixed income futures are pricing forward with respect to their expectations and what the Fed is putting forward in their dot plots as well as in their comments. We would be of the camp that I think it's a done deal with respect to December. There's just not enough time and not enough data to change that. March, however, is a little bit more open, but with respect to where fixed income futures markets have priced their expectations, we think they're still a little bit on the dovish side of what we'll actually get to experience. The Fed appropriately is preserving its optionality because it has all these exogenous risks that are in front of it, whether that's the trade and tariff restrictions or the other montage that we've iterated. What does that mean for an investor? Well, if you can be nimble, which is of course hard, be nimble. But otherwise you have to be patient around a diversified multi-asset portfolio, and that's what's going to have the highest probability of helping you navigate this.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.